Welcome to your market brief for the week of May 11th. The rift continues to widen between Wall Street and Main Street. The U.S. lost 20.5 million jobs in April, bringing the unemployment rate to 14.7%. That's the highest since the Great Depression. However, stocks continued to climb higher. The Dow posted its first weekly gain in the last 3 weeks. This week, can markets rally amid more troubling economic data? For guidance, we're joined by Barron's reporter Carleton English. Carleton, always a pleasure to have you on. Thanks so much for joining us.
Great to see you this morning. How are you?
Carleton, new week, futures a bit more uncertain today, but what's your take? What's behind the optimism and how much longer can this rally go?
Yeah, it's funny. Everyone always says that the market is forward looking. So everyone's kind of expecting things to be better down the line than they are now. But you've got to wonder if people are looking at this market through a foggy window because we really have no visibility and there's a lot more uncertainty. The market is trading up on news that's kind of good or not as bad as feared. But going down the line, we still don't have a cure for the virus or a vaccine or even enough testing. Still a lot of other uncertainty with the unemployment figures. I mean, this is really high, scary figures, but for some reason, the market right now wants to say, you know what, 2020, we're going to discount it and look ahead to 2021. Whether or not that's a good idea, I'm not so sure.
If the coronavirus pandemic has taught us anything, it's really been the importance of savings. I'm sure many of the 30 million plus people who are without jobs right now could attest to that. Following up on your recent article, where are the best places to put your cash with interest rates at essentially zero?
I almost feel boring for saying this, but a savings account, if you're really looking just to hold on to cash because maybe you have some income uncertainty and just want to make sure you're protected against that. But the thing is with savings accounts right now, if you're going to your brick and mortar bank, to your point, interest rates are low, you're probably getting close to nothing on that money. However, there's a number of online banks, markets by Goldman, Ally Bank that are offering rates in excess of 1%. And that's even rivaling what you're seeing in a lot of CDs, 12-month CDs. So one place to look is, make sure that some of these online banks are FDIC insured, which of course Ally and Marcus are. But you can put your money there and you also have the 100% liquidity. Whereas with the CD, you pay a penalty if you withdraw too early many times.
It can be tempting, though, to go after bigger rewards than 1.3, 1.5%. Bigger rewards means bigger risks, but let's talk about the dangers of chasing high yields.
Exactly. So, when you're looking at, high yield debt, for instance, there's a reason why they call this stuff junk. There are certainly experts who have made a career, successfully trading in distressed debt. But again, to what we were saying earlier in the market, there's not a lot of visibility. It's not yet certain what some of the fiscal and monetary policy measures will do to support debt. So, if you're looking to just hold on to cash and preserve it, you're probably just better off, sticking with something safe, something that is something where you have visibility.
My thanks to Carleton English. Be sure to catch Carleton alongside Jack Otter on Barron's Roundtable every Friday at 10 p.m. Eastern Time on Fox Business. All right, let's move along and take a look at the week ahead, starting with several crucial economic reports as investors await more clarity on the challenges facing the U.S. economy. The Bureau of Labor Statistics releases April's Consumer Price Index on Tuesday and Producer Price Index on Wednesday. Plus, we'll get weekly jobless claims on Thursday and data from the University of Michigan on Friday regarding the health of consumer sentiment. On the earnings front, major companies reporting this week include Duke Energy on Tuesday, Cisco on Wednesday, and then Applied Materials and Norwegian on Thursday. We'll be keeping a watchful eye on the cruise line, and on that note, I recently spoke with Tuna Amobi, equity analyst with CFRA Research, for a preview of what investors can expect when earnings cross for Norwegian later this week. Watch this.
Norwegian Cruise is the smallest of the three major global cruise operators, and that has put them in a little bit of a more of a disadvantage relative to the bigger size, cruise operators. The shares are down, 80% year to date. So that's a pretty dramatic decline for a company coming into this year that actually was looking really up, looking to have a record year before the COVID-19 hit. So we know that it's going to be a pretty brutal quarter. They had actually just earlier this week pre-announced some of the numbers, which really came in line with what we expected was going to be an extremely difficult quarter. More importantly, they raised in one of the regulatory filings potential doubts for the first time about their ability to continue as a going concern. So that fact alone added to more trepidation and got a lot of investors spooked because it's just one of the only cruise operators so far to have formally raised that issue. And when we look at their balance sheet, frankly, there's a lot of near-term debt maturities that the company was already grappling with even before this latest announcement.
In terms of the entire cruise industry, and what the future holds for it, we heard that Carnival plans to start sailing again in August and apparently has been inundated with bookings. But is this something that can go back to normal? I've never cruised, but it just seems like thousands of people on this floating kind of petri dish doesn't seem all that conducive to staying safe and social distancing measures. I mean, does this business model totally change?
There's no question in our mind that it's going to be a new normal when things settle down, which frankly could take quite some time. There's a lot of lack of visibility right now as to when the industry might return to any semblance of normalcy. In the case of Norwegian Cruise, all of their global cruise operations are temporarily shut up, at least through June 30th. And you talk about Carnival, even the summer, to me at this point, seems quite optimistic. And when they get to that point where they can start cruising again, there's no doubt that it's going to be really, really look nothing like we know today. There's a lot of safety protocols that have to be in place for guests, which frankly is going to be quite inconveniencing and might detract from that entire experience. As we speak now, the CDC still has a no-sail order. And at this point, we don't know when that order might be lifted. So it's not really up to the companies, frankly, at this point to decide when they can get back to normal again. And if they do, there's a lot of consumers out there that we've spoken to. And it's kind of ironic because I, with my family, took my first cruise last summer. And just, while it was a positive experience, I personally cannot imagine myself going back to that scenario anytime soon, because as you alluded to, it's really looking like a petri dish of potential infections or calamity or whatever you want to call it. So there's going to be that section of consumers that's going to be really staying away for some time, including me.
Many thanks to Tuna Amobi of CFRA Research. All right, that concludes today's Market Brief. I'm Caroline Woods. As always, stay healthy, stay safe. Thanks so much for watching.